The company keeps buying at lower and lower prices, but profits keep falling. What's going on? Shall we peel this pineapple all the way to the end of this video? Come with me. Hello! Today we're going to talk about something very important, this pineapple that many companies face, which is you keep buying better, you keep buying cheaper, and your margin is in free fall. What's going on? Let's peel this pineapple all the way to the end of this video and understand. I'm going to show you this mind map about costs, about strategies, about how you should buy cheaper and still maintain your margins. So what do we have within the scope here of our buying cheaper and selling at a profit? It's natural. A company wants to buy cheaper and it wants to increase its margins by making strategic purchases. But why is it that when a company makes strategic purchases, it sometimes can't actually realize that profit? The average cost is the main problem in price and cost formation. But the average cost is a legal requirement for companies. First, we need to understand what average cost is. So the average cost is nothing more than, for example, you buy a product for 1,000 reais, you make a purchase of 1,000 reais, and there are 100 units in that 1,000 reais purchase. Excluding taxes, you would have an average value of, for example, 10 reais. 100 units at 10 Brazilian reals, each will total 1,000 Brazilian reals. And then you have an average cost for the purchase. So how does this work? Obviously, you have to take taxes into consideration. Additional expenses, import costs if you are an importer, exchange rate fluctuations, all of these impact your cost. No one here is so inexperienced as to not understand this, but it's important to emphasize it in this presentation, especially since this is a class about strategic purchasing. Regarding taxes, what else can you do to calculate the average cost? You have recoverable taxes, ICMS, PIS, COFINS, IPI, and non-recoverable ones, UI. Merchant marine fees, etc. If you are an importer, IPI can be a cost in your business. If you are, for example, a reseller in the domestic market who does not recover taxes, you do not highlight IPI, so you should not consider it. The same goes for simple taxation, or if your product has a zero tax rate. You can consider it a cost. But I recover and deduct this from other taxes. That depends on your importer. But it's important for me to emphasize here that, of course, calculating the average cost is not such a simple task. But you have to take these four factors into consideration: the taxes, additional expenses, import expenses, and exchange rate evaluation. In theory, there could be more items impacting your costs, but 98% of it is covered here. So, calculating the average cost is a necessity for every company, especially for those under the actual profit regime. And what is the Cardex? Cardex is nothing more than a simple account that you do with your inventory, which is your cost and opening balance plus your purchases minus your sales. So how do you calculate the average cost? It's the opening balance plus purchases minus sales. So you will always calculate this. And there is a process called Cardex, which your software probably handles, since we're focused here on B2B companies, medium and large businesses. You probably already have this in your company, you know what it means, so we won't dwell too much on this task. But it's important for you to understand the Cardex process in this context, because it will indeed impact your account strategy. Within this issue of inventory, let's see how it works. The average cost is the final inventory divided by the quantity in stock, so the value, the total cost. With each new purchase, your cost can change. And what do I mean by that? What does Q-Shop mean by that? It means, imagine you had 1,000 reais with 100 items at a cost of 10 reais each, after deducting all taxes and fees, right? Doing all that accounting math, you would end up with a cost of 10 reais per item for 100 items, which would total 1,000 reais in inventory. Then, for example, you bought 10,000 reais worth of goods. Then you're going to have a huge impact. But imagine you bought 8,000 reais worth, 1,000 items for 8,000 reais. So you'll have a 20% reduction in cost on that purchase, but your average cost will be around maybe about 8.10, 8.20. But what does that mean? It means your average cost will go down. This impacts margin analysis, it impacts price analysis, price formation. So imagine a company in the following scenario. Look, there's going to be an increase in raw materials, there will be an increase in supplies, and the supplier is selling a batch below the usual price. What will happen? You go there and make that purchase. And then you have a difference in costs. You will have a reduction in the average costs of those items purchased below the normal market prices. This is going to be good. In theory, this is very good for the business in terms of reducing costs, but it's only good when you do it the right way. The way Kardex works, it will directly impact your average cost and will probably affect other scenarios as well. But before we get there, I want to show you one more situation, which is the issue of price formation itself. How does the Brazilian market work? How does the B2B distribution and import market work? And also, why not say factories within the Brazilian market? How does it work? It works as follows. Companies work with the formula selling price minus cost equals profit. So it's the market that determines the price. You have competitors, you have market competition. So you will always have to set your price based on the market reality. You can't just sell for 3 times what your competitor charges and then you have your cost equal to profit. So this is the theory that applies to most businesses. I'd say about 98%. You who are watching me will probably say, Marcos, I include myself in this category. Yes, because 98% of companies are in this situation. Price is a market benchmark. You can't stray too far from it. You might be 5%, 20%, 10% higher, but in many cases, even a 0.5% difference from your supplier and you already lose out on price. And the only alternative for you to improve your profitability is by reducing costs. A strategic purchase makes a lot of sense for this type of company. And I'm talking about 98% of businesses. There is another group of companies where cost plus profit equals the selling price. Let's put it this way. Cost is not very relevant in these businesses. Shall we give an example? Monopoly and innovation. Well, if you have a unique product on the market, you launched it, you set your price and you set your profit. For example, you developed some new technology, some new product that solves a problem out there. The problem isn't cost. The problem is making the product available on the market. So, all right. And as for monopolies, you can look at, for example, steel companies, oil companies like Petrobras or banks. They operate here with cost plus profit equals selling price. So Brazil has some monopolies, but we practically don't serve any of them. We're always among this group here, the mortals, so to speak. Then you have another group that we also serve, which are the clients of what? Where, for example, you have selling price minus profit equals cost. What does that mean? It's a managed strategy, and that's what I want to help you develop to peel this pineapple all the way to the end. At least part of this managed strategy I'm going to give you today in this video, in this lesson. So this managed strategy is used by less than 5% of companies. They pay full attention to their numbers. They're not careless. They're not inconsistent with their numbers. They pay a lot of attention to their numbers, but that's only 0.5% of companies, okay, folks? Most companies operate on autopilot. Oh, I'll buy cheaper, so I'll sell cheaper. I'll buy at a lower price, so my profit will increase. Not always, okay? Not always. Your purchasing gains stay up your sleeve, not in the average cost. So the big insight I want to give you here is that purchasing gains stay up your sleeve, not in the average cost. This means that the average cost is not used for the commercial area. A different factor is used. You shouldn't use the average cost to update your price list. But then we need to understand another aspect of the business. Another aspect of the business, the variables in pricing. There are many variables, really a lot of variables. So I'm going to show you some of them here. Here's a situation. For example, in the B2B market, you have third-party materials that account for between 25% and 60% of the net selling price. And the biggest weight is in raw materials. So if you buy a raw material at a lower price, imagine you're a steel company. And then you bought a raw material that has a huge impact on your cost and your prices. This is where the problem lies. So what am I going to manage? I'm mainly going to manage the A curve, which is the most important curve for my business, which is the raw material. You also have situations involving packaging and industrial supplies. But this whole group represents between 25% and 60%. I would say that today the average is around 48% for most B2B companies we come across in terms of net revenue factor. There are also internal costs. Oh, but I managed to reduce staff, electricity, rent, third-party services. Yes, here the company usually gains productivity, it makes some savings, but this represents between 10% and 30%. Let's go over this again. This here represents 60% of the cost. So generally, internal costs represent about half the importance of external costs, which are heavily negotiated by your purchasing department. There's also the issue of margins. What are the margins? You can work within a desired product margin, which is the list price, and how does that impact my purchasing? Yes, because when you work with margins to set the list price, which is usually how people do it, the impact comes from taking the cost and setting the price. You're just like that guy from Monopoly. But okay, you said it. You already know your market works with a 10% or 15% margin, so you might set a desired margin of 18% or 20% and a minimum margin of 8% to 10%, which is the lowest limit within the market average. Within that, you have several scenarios. You have the scenario of the current markets your company is in, whether sales are good or bad. You're going to set those limits. Volume, loyalty, and the actual product mix, the package the client buys from you. So this is important to know, because when you set a price list, when you define a pricing strategy, companies usually work this way. It works with a discount policy for the client, runs a loyalty program, marks some important clients with differentiated margins, especially regarding minimum limits. All of this can be impacted by you buying better, okay? It means that you are buying better. We're not getting off topic. The focus is that you are working with a price list based on price formation, considering taxes, costs, margins, and which cost you are actually using. So this will directly impact your business. When it comes to taxes, you have taxes on your revenue. Some people set the sale price and then add the taxes on top. Usually, if you're a multinational, a publicly traded company, or even a privately held corporation or a large company, you'll set your price and then add the taxes. But in the vast majority of B2B businesses, the tax falls on the profit and also on the taxes themselves. And this is a calculation where one tax is included within the other and one is levied on top of the other. Is this wrong, folks? Well, from an accounting perspective, this isn't 100% correct. However, everyone works in the way they think is best. So you also have this incidence here that directly affects price formation. And on your results, income tax and social contribution usually apply when you are under actual profit and when you are under presumed profit, or if you have a smaller company, your income tax and social contribution can also be levied on your revenue. This will have an even greater impact on your purchasing strategy. The more factors you include in your price formation, the worse your strategy for cheaper purchasing will become. I'll explain why in a moment. And regarding tax incentives, you might have a client who buys and receives special tax treatment in the state where they're located. There are many such situations, for example, in Suframa or for exporters. There are also cases specific to your own company. Maybe your company has tax benefits for certain operations, or you're in one state and sell to another and you have presumed credits and so on. There are also special situations, like when you're selling to a client who has a public works project there. I don't know what else. There are also reductions and so on. So all of this you factor into your price formation, which is also impacted by taxes. There are other variables as well, like freight, routing, and financial costs. So when you're setting your price, you have a lot of factors, right? A lot of variables you can consider. That's what I wanted to convey here. There are many variables involved in setting a price, but they all start from the same point, which is the average cost. So, generally, a company that uses average cost to set prices or to analyze the profitability of the commercial area is indeed being impacted, and you need to stay until the end of this lesson to really understand the whole process and what happens. All right, so what have we learned? What is average cost and how are prices formed? This is nothing new for anyone in our B2B target audience. People already know this backwards and forwards, but it's important for us to use this as a starting point so you understand that the whole process depends on having a well thought out, well managed and strategically managed cost. So how do ERPs work? The ERP, for those who don't know, is a term for standard management systems. Here, they handle everything inside the company. Just imagine everything that happens from the purchase order onwards, from the sales order, these systems manage it. So there are systems, let's not name any specific ones here, but there are large-scale and small-scale systems called ERPs, which manage everything from the arrival of goods to the issuance of the invoice, from the order entry to billing the client, collections, and so on. And these systems work with average cost, which is used throughout the entire system. But why do we need to understand that it is used throughout the entire system? Because the software, since it operates internally, how does it work? They always operate with a focus on the Brazilian tax process. And what is the Brazilian tax process? There are income tax rules that require the use of average cost, so it complies with tax authorities. International accounting, to meet the needs of partners and investors, will also have to work this way. Cost accounting, which is meant to serve the company's internal management and price formation. This is where the problem lies. This is where the system ends up failing, because price formation is being done according to all of this. And then you ask, well, how can I solve this issue of price formation? How can I resolve this situation within my company? Now we're going to get to the problem. Up until now, we've understood how everything in the business works. So how is the average cost calculated? It's the Cardex, the famous Cardex. Price formation is based on the average cost, and business management software is focused on the average cost to meet a range of demands. It's not just the commercial area, it's not just the pricing strategy. It is focused on various legal, statutory, and corporate obligations that it needs to meet. So there's no way for an ERP system to have two costs. It's unlikely and maybe even illegal to have two costs within the same system, right? But if I buy at a lower price, what's the harm? It will lower my cost and increase my margin. Here's the big problem. What is the problem? Strategic purchases. Shall we take a look at strategic purchasing? What happens with strategic purchasing? Large volumes. First, you tie up your cash flow. Second, you tie up physical space. And third, often you buy a product that doesn't have much turnover. It's not something you'll sell the following month, and you end up getting stuck with it, tying it up in inventory for months or even years. Usually it's months, 5, 6, 3 months. You buy, say you used to use 100 pieces a month, 200 pieces a month, but you buy 1,000 to get a better price, and the company ends up tying up part of its cash flow and also its storage space. It's important for you to know this when you're doing the math, but generally this isn't news to anyone. The reduction of one-off costs without the recurrence of this condition. Let's even highlight this in red. What happens when you have a cost, and let's go back to that example, of 1,000 reais, 100 pieces at 10 reais each, and you buy 1,000 pieces at 8 reais each, you ended up reducing your cost. When you reduce your cost, that's very good, apparently. And then you have this cost reduction, and when you use the average cost, what happens? Shall we? Average cost straight to the point. The entry of the invoice from this strategy goes directly to supply the product's cost, and it gets updated. The price list, whether at the end of the month or every day, if you work with a commodity, you probably update the price list daily, and it gets updated. And then it ends up impacting the sales margin on the margin of the commercial department, of the invoices and quotes, as a result of this cost reduction. But there wasn't a drop, folks. There was a negotiation to buy better. It's just that this communication has flaws. The system works automatically when that blessed purchase invoice is entered. All of this happens in your software. All of this happens instantly. You don't even notice it. Imagine you have a product that uses 3 inputs. You bought it cheaper, the cost went down. You don't know if it really went down or if there was an effort from the purchasing department to actually achieve this desired cost reduction. No, the market price really didn't drop. We just managed to buy better that one time. That's where the problem is in these one-off purchases. The sales team finds out, hey, the cost went down, and some clients are informed. Automatically, if the margin went up or the price dropped, the client is immediately informed and it goes straight to the limit. And we're talking about active clients, okay? It's rare for sales teams to go after inactive clients to win them back when prices drop. It's usually like this. Oh, the margin went up, the client complains, so I'll sell at the minimum margin. Remember when I talked about minimum margin here, about pricing? That's right, so I have room to lower the price. Then comes the second point, to deal with this headache. You bought at a lower price, so all the negotiation margin, whether it's 10%, 5%, 3%, 30%, it doesn't matter. The company often allocates 3 or 4 million, and that's for small companies. There are very large companies that move 100 million in purchases to buy cheaper to get a better cost. And it goes straight to the core of the margin, and then sales management, the commercial team, ends up lowering the price unnecessarily because the market price hasn't dropped. I'll say it again. This happens in many cases. Okay, folks? I'll tell you. 8 out of 10 companies work this way, and what happens then? Cost went down, the price stayed the same, the margin increased. If the margin increased, the score went up, it increased. The rating, the average margin went up, but there was no increase in sales. There was a gain in purchasing, and the price is not going to go back down. But what happens then? You start giving more discounts to reach that mental margin. Oh, the customer pays a 10% profit, and then the cost dropped by 15%, so the price should drop by 15%. To put it simply, oh, so I'll lower it. But what happens? Let's go. The new purchases. The new purchases have a problem. The strategic condition ends because you bought millions or thousands of rays worth of goods to buy cheaper, and for you to put that into your cash flow, this financial benefit from the discount. And then what will happen? The average cost is updated, the average cost goes up. Why? Just as it went down, it goes up. Maybe not in the same proportion, but if you only made one cheaper purchase, you were out of stock and bought at a lower price. It's the worst of both worlds. You had 0 stock and the cost was 10 Brazilian reals. You bought 1,000 units at 8 Brazilian reals and you sell 1,000 per month. The following month you'll buy at 10 reals and 50 centavos. Sales margins automatically drop because the cost has been updated. So when someone goes to make a quote, what will happen? The selling price has to go up or the margin drops. And then the customers reject this increase. The company records a drop in profit. So what happens? You bought at a lower price, but this whole mechanism, this whole process is set up to meet tax requirements, to serve society, to fulfill a bunch of things. Your purchasing strategy isn't working. It's a huge headache. So how do you solve this problem? I'll get to that in a moment, but let's focus on these red areas. I buy strategically, but my sales margin automatically drops when my purchasing strategy ends, or when that commercial condition for my supplier was just a one-time thing, a clearance, a batch he needed to get rid of, and I'm using it, and so on. Okay? But when it gets to the sales department, the client rejects the price increase. What's going to happen with the salespeople? Look, we can't pass on the price. The client isn't accepting it. The buyer over there says he won't buy from us anymore. And that's when the nightmare begins. It's one nightmare after another. And who caused this? Yes, it was the buyer trying to improve costs. Is it the buyer's fault? No, it's the process's fault. The process isn't managed. The purchasing process is great for getting discounts. The buyer deserves an award. The problem is he only managed it once. He didn't achieve this continuously. It was a strategic purchase that allocated space, allocated financial resources, that did a bunch of things that is taking up things in the company. And when it got to sales, sales lowered the price. Why? The cost went down and he didn't even know why the cost had dropped, so he lowered the price. Then, when the price returns to normal, he needs to readjust it. And no client accepts a price increase. That's when the fight starts and profits gradually decline. The better the buyer, the bigger the one-off discounts, the worse your margin will get in the medium term. That's what I wanted to tell you. For those of you who are still watching and have had the patience to stick with me here. So what strategy would Ikeshap and our company suggest? Just so you know, we've been working in this area of cost management for 23 years. So I've seen a lot of mistakes being made because of the numbers, and I've seen companies lose a lot of money without knowing why. And one of these cases here might be happening in your company. Your company might be losing money because of this. So I'd like you to share this video, give it a like. If you'd like to honor us by subscribing and turning on the notification bell, that would be really great. So let's get to the conclusion of this suggested strategy. What should we do with strategic purchases? They're only strategic and profitable when. So understand, they don't impact the sales margins. If I buy at a lower price, it can't be visible to the sales department. It can't in any way, it just can't. In Ikeshap, we already have all these mechanisms that regulate these costs and prevent strategic purchases from affecting the statistics and price formation for the sales team. So if you want to know more about this, we can explain it to you. So you can keep using your system, especially since all RNP systems are for internal operations and Ikeshap is a complementary system that works externally. It addresses one of the main points, which is exactly this, not impacting the strategy. A strategic purchase, where should it show up? In the balance sheet, in the income statement? Yes, of course, it will show up there. If you buy something cheaper, it affects your inventory and costs from an accounting view. It's not a gain for sales, but for purchasing. The purchasing department's gain should be shown in the income statement. Okay? Let that be very clear. Of course, there are situations and analyses, which is why we talk about managed strategy. Okay? And they will not impact price formation. What usually happens is that all strategic purchasing situations are having an impact. You should not use your strategic cost in price formation. This is something that's almost obvious. But 8 out of 10 medium and large companies don't do this, because they follow a process from IRB systems, which are set up once again to address various situations. In this strategic situation, no one deals with it in any way except to complain. Then you have performance analysis. Let's go. What about performance analysis? What about strategic purchasing? You have accounting, partners, and tax authorities. These guys will know about your strategic account because it will directly reflect in your finances. And what about the commercial cost? The market will provide the commercial cost. What is the commercial cost? It's the cost I'm explaining to you that comes without the purchasing strategy. The commercial cost is not tied to the invoices, to the purchases you make on a daily basis. This cost is linked to the commercial reference. So if I have an extra discount, a strategic discount, it won't be included here. But if by any chance I have expensive inventory and my commercial cost is lower, it will result in